There are many ways to invest your money, from stocks and bonds to real estate and mutual funds. The options are vast and varied. Some people try to time the market, hoping to maximize their returns. They want to buy low and sell high, aiming to capitalize on market fluctuations. But this is very hard to do. Market timing requires not just skill, but also a bit of luck. You need to be right twice. First, you need to buy at the very bottom. Identifying the lowest point is challenging, as markets are unpredictable. Second, you need to sell at the very top. Knowing when to exit is equally difficult. That's really hard, even for professionals who spend their careers studying market trends. A simpler way to invest is to use dollar-cost averaging. This strategy involves investing a fixed amount regularly. Dollar-cost averaging is a strategy that removes emotion from the investment process, making it easier to stay consistent. Dollar-cost averaging is a long-term strategy. It smooths out the highs and lows of the market. That means you need to be patient. Over time, this approach can reduce the impact of market volatility. But over time, dollar-cost averaging can help you build wealth steadily and securely, providing peace of mind. Dollar-cost averaging is simple. You invest a fixed amount of money at regular intervals. You do this regardless of the market conditions. It doesn't matter if the market is up, down, or sideways. You keep investing. For example, let's say you want to invest in the S&P 500. You could invest $100 every 2 weeks. You would keep doing this, rain or shine. This strategy takes the guesswork out of investing. You don't need to worry about timing the market. Just set up a schedule and stick to it. Let's look at an example. Imagine you want to buy a cost averaging. You could invest $100 every week. Down to $40. This means your $100 for your money. This is advantageous because you are in your investment. Over time, the average price of the market. This is the power of dollar cost and reduce the impact of volatility, because when the price is high, you lower your average cost. Section 4. The power of dollar cost averaging. Dollar cost averaging has many benefits. First, it reduces risk by spreading out your investments over time. When the market is volatile, dollar cost averaging helps you avoid buying high and selling low. This strategy ensures that you purchase more shares when prices are low and fewer shares when prices are high. Second, it is a disciplined approach to investing. By investing a fixed amount regularly, you stick to a plan and avoid impulsive decisions. It takes the emotion out of investing. This method helps you stay calm and focused, even during market downturns. Third, it is easy to understand and implement. You don't need complex strategies or advanced knowledge to get started. You don't need to be a financial expert to use dollar cost averaging. It's accessible to everyone, from beginners to seasoned investors. And fourth, it is a great way to build wealth over the long term. Consistent investing can lead to significant growth over time. Dollar cost averaging is particularly powerful for young investors. Starting early allows you to take full advantage of compounding returns. Time is on your side. The longer you invest, the more potential your investments have to grow. Section 5. Conclusion. Dollar cost averaging is a powerful tool for building wealth over the long term. It is simple, effective, and accessible to everyone. If you're looking for a smart and disciplined way to invest your money, dollar cost averaging is a great option. Remember, invest consistently, stay the course, and let time work its magic. Don't forget to subscribe to our channel for more investing tips and strategies. Hit the like button and turn on notifications so you never miss an update.